The liquidity paradox and the floodplain illusion. The foundational architecture of the modern Miami real estate landscape is systematically misunderstood by retail participants who analyze the market through the obsolete framework of standard national housing cycles. To properly underwrite equity positions in this global gateway market corridor, an institutional professional must first strip away the superficial media narratives and execute a forensic, data-driven analysis of the physical, geographical, and capital infrastructures that dictate real-world asset valuation. The primary structural error made by external capital pools entering the South Florida market is the reliance on the broad, undifferentiated macroeconomic data layers that aggregate regional performances into a single, misleading metropolitan narrative. Miami is not a singular, uniform real estate market. It is a highly fragmented, highly volatile matrix of micro corridors where structural viability, local elevation baselines, municipal tax infrastructure variations, and institutional capital deployment velocity change drastically from one block to the next. The casual consumer observes a skyline filled with architectural glass towers and sprawling suburban compounds, assuming that the underlying economic driver is a uniform wave of residential demand. This asset class perception is completely detached from the systemic infrastructural realities driving the grid. To demystify the Miami real estate landscape, we must first dismantle the prevailing cultural myth of the universal floodplain liability. The common external narrative suggests that the entirety of the South Florida coastal shelf is facing an imminent uniform structural collapse, driven by rising sea levels and uncontrollable environmental drag. This perspective ignores the clinical geographic reality of the coastal ridge infrastructure. The geological substrate of Miami-Dade County is divided into distinct localized formations that create massive disparities in elevation and structural resilience. The Atlantic Coastal Ridge, a limestone formulation that runs parallel to the coast through specific neighborhoods like Brickell Hammock, Coconut Grove, and portions of Coral Gables, sits at significantly higher elevations, frequently reaching 8 to 12 feet above sea level. Conversely, the low-lying historical Everglades drainage basins, reclaimed marshlands, and specific unengineered coastal fill areas in western Miami-Dade, Fontainebleau, and portions of Sweetwater sit on an entirely different topographical baseline, often measuring mere inches above the current water table. When institutional underwriting desks evaluate structural asset longevity, they do not apply a blanket environmental discount across the entire zip code matrix. Instead, they execute a precise micro-topographical assessment of the specific parcel. An asset situated on the limestone shelf of Coconut Grove operates under a completely different risk profile than a structurally identical asset situated within a historical drainage canal basin in the western suburbs. The real risk is not a generalized environmental catastrophe. It is the hidden operational cost of localized water table saturation, which accelerates the degradation of subterranean foundation components, compromises unreinforced cast iron plumbing infrastructure beneath the slab, and drives localized stormwater retention fees. Retail buyers routinely overpay for cosmetic renovations, such as premium quartz countertops, imported porcelain flooring, and designer elastomeric paint applications, while completely failing to audit the underlying infrastructure of the asset. In a tropical climate environment with highly aggressive atmospheric salinity, rapid thermal expansion cycles, and recurring localized saturation events, the structural envelope of the building dictates its true economic lifespan. A residential structure built in the mid-20th century that has not undergone an engineered foundation stabilization, an administrative cast iron plumbing replacement, and a complete hurricane hardening of its structural apertures is carrying a massive load of deferred structural liabilities. These hidden liabilities can instantly liquidate a buyer's equity position the moment a mandatory municipal or county inspection occurs. Furthermore, the capital dynamics of the Miami market are driven by an unprecedented volume of international and domestic wealth preservation capital that treats South Florida real estate not merely as a primary residence, but as a sovereign physical bank account. This institutional sovereign capital functions as a structural price floor in premium coastal and urban cores, operating completely independently from standard local wage-to-price ratios. The vertical housing inventory of Miami is currently undergoing the most radical regulatory and economic restructuring in its historical trajectory. For decades, the retail public viewed Miami's high-rise condominium market as a low-maintenance, turnkey investment vehicle that offered a luxurious lifestyle without the operational headaches of managing single-family home infrastructure. This perception was completely shattered by the institutional implementation of mandatory structural integrity, reserve studies, and strict post-disaster structural safety legislation. The contemporary Miami condominium market is no longer a passive residential play. It is an active financial battleground where underfunded association reserve ledgers are forcing a mass liquidation of retail equity. Prior to recent legislative overhauls, condominium associations across South Florida routinely exercised a dangerous operational loophole, the collective voting mechanism to waive the funding of deferred maintenance reserves. To maintain low, artificially suppressed monthly association dues and attract retail buyers who analyzed affordability purely on surface-level monthly fees, boards consistently voted to defer structural savings accounts. For 30 to 40 years, these associations operated with completely empty reserve balances, pushing the inevitable financial liability of roof replacements, structural concrete restoration, and elevator modernizations down the road to future, unsuspecting owners. This structural negligence worked as a temporary liquidity illusion until the structural reality of aging reinforced concrete met the unyielding force of modern regulatory compliance. Under contemporary state regulations, the era of the underfunded, waived condominium reserve is officially dead. All vertical residential structures 3 stories or higher are now subject to mandatory milestone structural inspections and structural integrity reserve studies, SIRS. These structural audits mandate that every association must perform a clinical engineering inspection of its primary structural components, including the reinforced concrete load-bearing framework, primary post-tension cables, roofing systems, fire protection systems, and seawall infrastructures. Crucially, the legislation completely eliminates the ability of condominium associations to vote to waive or reduce the funding of reserves for these structural items. The financial impact of this regulatory shift is causing an immediate systemic repricing of older vertical housing inventory across Miami-Dade County. When an engineering firm conducts a structural integrity reserve study on a building constructed in the 1970s or 1980s and discovers millions of dollars in unaddressed spalling concrete, corroded post-tension tendons, and compromised electrical systems, the association is legally required to fully fund the remediation timeline within their annual budget. If the association's reserve ledger has been neglected for decades, the only mathematical mechanism available to bridge the capital deficit is the immediate implementation of a massive special assessment or a catastrophic, multi-100% increase in the monthly maintenance dues. For a retail condominium owner who acquired an asset based on an obsolete affordability calculation, these sudden 5 to 6 figure special assessments represent an immediate financial emergency. Because the vast majority of retail owners do not possess the liquid capital required to fund a $50,000 or $100,000 sudden structural assessment, they are forced to list their units on the open market simultaneously. This triggers an immediate hyperinflation of localized inventory within older, unrenovated towers, shifting the balance of power entirely to institutional distressed capital buyers who underwrite the property based on its land acquisition value rather than its current residential utility. This phenomenon has created a massive permanent divergence in the Miami condominium asset class, separating the market into 2 distinct categories: compliant, fully capitalized modern towers and structurally compromised, unfunded legacy towers. Modern vertical developments built under the strict post-1992 South Florida Building Code protocols are engineered with significantly higher structural tolerances, comprehensive impact glass integrations, and modernized reserve management practices. Older legacy towers, particularly those built along the immediate open waterfront of Miami Beach, Brickell, and Key Biscayne prior to the implementation of modernized building codes, are facing a compounding cycle of accelerating physical degradation and escalating compliance costs. The single most disruptive variable transforming the operational cash flow dynamics of the Miami real estate ecosystem is the structural restructuring of the property insurance market. To longtime participants who entered the market during the low volatility cycles of the past decades, insurance was viewed as a standard, predictable pass-through cost that had a nominal impact on the asset's overall capitalization rate. In the current market environment, property insurance has evolved into a primary underwriting constraint that dictates whether a transaction can legally close, whether a commercial banking institution will maintain its capital commitment, and whether a property owner can maintain positive cash flow on their balance sheet. The prevailing national myth surrounding South Florida's insurance crisis is that the massive premium increases are driven solely by the physical destruction caused by major landfalling hurricanes. While catastrophic storm events represent the absolute baseline risk parameter used by global reinsurance syndicates to model their capital allocation exposure, the real drivers behind the unprecedented escalation of Miami property insurance premiums are structural litigious vulnerabilities, historical regulatory loopholes, and shifting actuarial models that have fundamentally altered the pricing of risk. For years, the Florida property insurance landscape was plagued by systemic structural vulnerabilities within the legal framework, most notably the widespread assignment of benefits, AOB, and third-party litigation schemes. These legal loopholes allowed roofing contractors and public adjusters to convince property owners to sign over their insurance policy rights in exchange for a free roof replacement following standard, localized wind or hail events. The resulting explosion of property insurance lawsuits forced carriers to spend billions of dollars defending legal claims, creating an ununderwritable legal environment where Florida accounted for a massive percentage of all property insurance litigation nationwide, despite representing a much smaller fraction of actual homeowners' insurance claims. Although comprehensive legislative reforms have systematically dismantled these litigious frameworks, eliminating the assignment of benefits and third-party fee-shifting mechanisms, the structural damage to the private insurance capital pool was already done. Dozens of domestic property insurance carriers experienced severe capital depletion, forcing them into insolvency or prompting them to permanently withdraw their underwriting capacity from the South Florida market grid. This massive contraction of private carrier capacity triggered an immediate supply and demand imbalance, allowing the remaining institutional carriers to completely rewrite their risk tolerances and demand unprecedented premium adjustments. To understand the actual operational impact of this insurance restructuring on a Miami real estate asset, one must look at how global reinsurance markets dictate local pricing. Primary insurance companies operating in Miami do not retain the entirety of the catastrophe risk on their own balance sheets. Instead, they purchase secondary insurance protection from global reinsurance conglomerates based in capital hubs like Bermuda, London, and Zurich. Reinsurance syndicates utilize hyper-advanced computer-driven catastrophe modeling algorithms to calculate the exact probability of a multi-billion-dollar storm event striking the specific dense coastal corridor of South Florida. In recent years, these global reinsurance models have been completely updated to account for a variable known as climatological volatility drag. The algorithms no longer analyze historical storm trends linearly. Instead, they model a compounding risk environment where sea surface temperature anomalies, rising sea levels, and slower moving, higher precipitation tropical systems create exponential damage potentials. When global reinsurers increase their capital rates for South Florida risk exposure, those massive overhead costs are passed directly down the line to the local primary carrier, who immediately transfers that financial liability straight onto the end user's monthly escrow payment. This insurance premium inflation creates a direct, immediate stress test for any property owner utilizing commercial mortgage leverage. When a buyer secures a fixed-rate mortgage to acquire a single-family home or a condominium in Miami, their principal and interest payments are locked in for the duration of the loan. However, their total monthly housing obligation, the PITI payment, principal, interest, taxes, and insurance, remains completely variable because it is tied directly to the annual adjustments of property taxes and insurance premiums. The geographic distribution of value within the South Florida metropolitan grid is experiencing a major structural decentralization. For decades, the dominant real estate narrative in Miami was defined by a highly concentrated, monocentric premium model. Capital was deployed almost exclusively into a narrow, linear strip of immediate coastal and urban land, stretching from the historic waterfront enclaves of Coconut Grove and Coral Gables, northward through the high-density financial center of Brickell, and continuing along the barrier island shelf of Miami Beach, Surfside, and Sunny Isles. Any property situated outside this immediate coastal core was treated by institutional capital as secondary suburban sprawl, subject to severe cyclical volatility and lower long-term appreciation metrics. This traditional monocentric model has been rendered completely obsolete by changing domestic migration patterns, infrastructure bottlenecks, and a fundamental shift in how institutional wealth values physical privacy, structural elevation, and sovereign land control. The contemporary Miami real estate market is transitioning into a polycentric network of highly specialized, decentralized premium corridors. As the historic urban and coastal cores face hyperinflationary congestion, maxed out vertical densities, and escalating infrastructure drag, both domestic tax migration capital and institutional developers are systematically remapping the geography of South Florida real estate value. The primary catalyst driving this decentralized corridor shift is the migration of massive corporate enterprises, hedge funds, family offices, and multinational technology firms into the South Florida ecosystem. These entities are not establishing their physical footprints within traditional suburban industrial parks. They are constructing ultra-modern, institutional-grade commercial hubs in decentralized submarkets. When an institutional hedge fund establishes a major corporate headquarters in a node like Brickell or the newly emerging Miami Design District and Wynwood corridors, the high-earning executive and employment base instantly demands proximity to premium residential infrastructure. However, because the immediate coastal single-family inventory is severely supply-constrained and landlocked, this massive wave of purchasing power is forced to look inland, driving an unprecedented capitalization of specific western and southern micro-corridors. Submarkets that were once categorized by retail consumers as distant suburban enclaves, such as Southwest Ranches, Pinecrest, specific master-planned pockets of Pembroke Pines, and the highly elevated limestone ridges of Coral Springs, are experiencing a massive influx of ultra-luxury capital deployment. In these decentralized corridors, land is not measured in small, fractional coastal urban lots. It is acquired in multi-acre parcels that allow for the construction of fully self-contained, high-security residential compounds. To a high-net-worth individual migrating from a highly congested urban environment, the ability to acquire a multi-acre footprint that provides absolute physical privacy, independent water and energy infrastructure integration, and total insulation from urban density bottlenecks represents the ultimate luxury asset class. Furthermore, these decentralized submarkets possess a critical geographical advantage that is becoming highly prized by institutional underwriting desks: superior topographical elevation. While the historic coastal barrier islands and reclaimed bayfront areas must continuously invest in expensive civic engineering modifications, tidal pump station integrations, and street-level elevation projects to manage high tide saturation events, the inland corridors situated along the Florida Limestone Ridge sit on a naturally elevated topographical baseline. Submarkets located miles inland are naturally insulated from coastal storm surge matrices, significantly lowering their long-term environmental risk profiles and stabilizing their baseline property insurance underwriting parameters over a multi-decade horizon. To capitalize on this decentralized paradigm shift, an investor must master the raw mechanics of land acquisition and zoning optimization. In a highly saturated, land-constrained metropolitan ecosystem like South Florida, the structural improvements built on a piece of land are continuously depreciating over time due to physical wear, environmental drag, and technological obsolescence. The true permanent appreciating asset is the underlying land parcel itself. When you analyze a real estate transaction through an institutional framework, you must separate the total acquisition cost into two distinct ledger items: the structural improvement valuation and the raw land basis. With the completion of these acquisition protocols and infrastructure breakdowns, we conclude this technical analysis of the South Florida market. Every single section has been structured with a single objective: to eliminate the emotional variables of traditional real estate and replace them with empirical data, forensic analysis, and operational precision. This documentation will serve as the backbone for your upcoming campaigns, videos, and portfolio reviews, establishing an undeniable authority in the high-density market of Miami-Dade and Broward. The data engine is fully primed and locked in. Stop buying real estate blind. Demand the data matrix. Don't catch yourself falling for a pretty facade. If you're going to build wealth in South Florida, you need to play at the institutional level. In this video, we reveal exactly how we deploy military-grade thermal imaging and subsurface scanning to penetrate the walls and uncover the absolute truth of an asset before you ever write a single check. Real money is protected with hard data, not lifestyle hype. If you want to explode your equity and bulletproof your portfolio from hidden structural nightmares under the grass, you need to ride with the right team. Smash that follow button immediately so you never miss our hyper-localized risk maps, forensic breakdowns, and the absolute best off-market plays in Miami-Dade and Broward. Turn on your notifications and dominate the market with the smartest investor network in Florida. Somos South Florida Home Finder Team. Precision, infrastructure, unstoppable results.